our mortgage webinar with Kim Lee. Kim is a professional licensed mortgage broker with Hypotheca here in Montreal. Kim has lots of information to share with you, so I'll ask you to make sure that you have a pen and paper on hand to record any questions. Kim will answer all of them at the end of his presentation. Good afternoon, Kim.
Hi, Jennifer. Thank you very much for setting me up with this webinar. I'm a total no when it comes to these kind of things. I do know about mortgages, though, and I will hopefully be able to help you and answer some of your questions later on. Okay, so let's start. Today, I'm going to teach you how to qualify for a mortgage. I'm sure that when you go to the bank, the people, the agents of the bank, they don't actually give you the whole story, and they just kind of take your information, plug it in the computer, and they tells you whether you qualify or not, and that's about it. As a professional mortgage broker, I usually go to my client's house or meet them at the office, and I give them a little course before I find out what their actual needs are. So this is very similar to what I would do and when I go to see a client. Okay. So to start off, there are three things that are very important for the banks when they're qualifying a client. Credit, equity or loan to value, and income. So I'm going to break this down and go one by one and give you some detailed information on each of the criteria that the banks are looking for. Okay. So we're going to start off with the credit. As some of you might know or not know, there are three credit rating agencies in Canada. There's TransUnion, Equifax, and Experian. TransUnion and Equifax are the mostly used by the major banks. Experian is sometimes more for the commercial and other smaller agencies. I deal with Equifax more. When I pull out the report, all the banks usually will accept Equifax reports. What you pull out is the consumer report, which is slightly different than the professional reports that we get. The professional reports will give you a Rio Beacon score, which is between 300 to 900. And as you can see on the chart there, Experian, they have a different, what they call a plus score. It's between 330 and 830. And for TransUnion, it's what they call a FICO score, or FICO score, between 300 and 900. Okay. If you want more information about your credit bureau, I can suggest you to go to equifax.ca and pull out your own credit report. When you do that, your credit is what they call a soft credit check, and this will not affect your credit rating. If, for example, a financial institution or someone like myself, a professional mortgage broker, pulls one out, or a bank, this will affect your credit score. I'll explain that a little bit later on. So as you can see, the Canadian average is around 700. The target, which I suggest for clients to obtain, is 680. Because the higher your credit score, the more borrowing capacity you have. Okay? And because your score is better, it shows that you are less of a risk for the banks. And so they allow you to borrow you more money. And we'll get into that a little bit later on. Here are some examples of what affects the credit score. These are the actual quotes from a professional bureau that I pull out. And it would say things like these: number of accounts with delinquency. For example, if you have some lates and you skip a month or two, it would show up as R1, R2, R3, or the number of months that it has been late. And so if you have too many of those, your credit score is going to go down. Time since delinquency is too recent, it means that, for example, if you did have some late recently, it will take time for it to go away. It's comparable to a driver's license demerit points, where, for example, here in Quebec, you have 15 demerit points to start with, or 15 points to start with, and if you do have an infraction, for example, speeding or passing a red light, I believe they take 3 demerit points, but it takes 2 years to regain those back. So same thing with a credit score. It does take time to go back up. Serious delinquency and public record. For example, if you didn't pay your Bell Mobility bill because you moved 2 years ago and they kept sending you the old bills to the old house, there might be a collection on your credit bureau and you might not even know it. So that is why it's good to check your credit bureau once a year. For me, the credit bureau is like checking a doctor checking a blood analysis. I can see the bureau and I can make suggestions to how to fix your credit score and the treatment. I can give you an explanation on how to make it go back up. Portion of your balances to credit limit on revolving accounts is too high. This means, for example, if you have a balance, if you have a credit limit of 5,000 and you're, let's say, at $4,500 all the time, you could be losing, you are losing 15 points just because of that. So if you can bring that particular balance down to below 60% of the maximum amount, then you could regain that 15 points. Okay. Other things that can affect your credit score for sure is if, for example, your balance is 5,000 and you're always paying the minimum, and so just to squeak under the 5,000, but one day, because of interest costs and whatnot, or you forget to pay 1 month, the balance goes up to 5,030. Right away, you lost 35 points. So just by repairing this or fixing this, you can regain those 35 points. Okay. So again, for me, reading credit bureau is like a doctor reading a blood analysis. I can see, I can advise you how to fix it. Okay. I was trained for that. Not everyone who works at the bank will be able to do this for you. Equity again, loan to values, yes. So I have here an example of a purchase with minimum 5% down. Those are the rules today. And so your loan to value would be 95%. Okay, and the banks also want to see that you have some money aside for the closing costs, such as notary fees, land transfer tax, and the home inspection report, which is usually around $400 to $500. The land transfer tax you can estimate around 1%. Sorry, and notary fees can range, around $1,000, $1,200 approximately. Okay, so all these are costs which you should expect if you're doing a purchase. So, and we'll give you an example a little bit later on. If you do have more than 20% down payment, you won't need mortgage default insurance, and it will be called a conventional mortgage. Okay, so down payments of less 20% or less, you would need default insurance. which in Canada, we have three insurance companies that offer that right now. CMHC, which is a Canadian government agency, Genworth, and oops, it says Canada. Canada Guarantee. It should say Canada Guarantee. Sorry for the typo. They all have different or similar insurance products. So, for example, if you're a business for self-employed, or if you're a new immigrant to Canada, they all have programs for those clients, different clients. Okay. Now, CMHC, the insurance premium that you pay they're all the same. The Genworth and Canada Guaranteed follow the rates of CMHC. CMHC has canceled some programs recently for business for self. They used to have stated income, now they don't. So for people that are self-employed, you might not qualify with CMHC, but there are other programs with Genworth and Canada Guarantee. This is another thing that we can talk about in the future webinar. Can be quite detailed. So going on to our next slide. Here's an example of a purchase. For example, if the purchase price of the home was $250,000, the minimum down payment you require is $12,500. I put in the brackets there, you would need about $37.50 for the closing costs, which the bank will allow you to use your credit card if you have space. Okay, you don't necessarily need the funds on hand for that. Okay, but for sure the bank wants to see that you do have the $12,500. The down payment can be coming from a gift from a family member. But depending on the bank, they would want to see proof, whether it's in the account for a month or 3 months. So it depends on the bank. I do business with about 15 financial institutions, and each one of them have their own rules. And so it's a good advantage to work with a mortgage broker because you do have more choice. And we'll get into that a little bit later on. So in this example, the loan amount would be $237,500, and the premium, because you're only putting 5% down, is calculated. The factor for this one is 3.15, so it works out to $7,000 and change. So the total amount of the mortgage would be $244,981. I just used the rate 3% over 25 years amortized to give you this monthly payment. So this will give you a good idea. This is just an example. So we can go on to the next slide. Yes. For refinancing, the rules are a little bit different. Because of Mr. Flaherty that came out in 2012 with these new rules to tighten the money lending rules to help Canadians so that we don't get into a subprime situation like in the United States. He came out with lowering the amortization, the loan to value from 85 to 80% now for the refinance. So if your home, for example, has a value of 250, and when I say value of the home, we're talking about professionally estimated value. I mean, we always think our home is worth more than what it is sometimes, but it depends on the market, and a professional evaluator will evaluate your home. For example, when you come and when you go for a refinance, the banks will send someone. And this is usually no charge to the client, okay? Depending on the bank you do business with, of course. So in this particular case, you can only go up to 80% maximum for the refinance. Some people have lines of credit attached to it. So, and the rules are different for lines of credit secured by and immovable. You're only allowed up to 65% if you have a HELOC. But a lot of banks offer these hybrid mortgages where you have a part HELOC and a part fixed portion of your mortgage, so the payments are easier. Anyways, we can always talk about that in the next webinar. So continuing on, income. Yes, very important, the income. There's all kinds of income. Some of us have salaried jobs. Some of us are commission-based, like myself, a mortgage broker. I get commission by the banks. I get paid by the banks, and not by the clients, so which is good news for my clients, depending on the file. Okay, so I'll explain that a little bit later on too. And business for self. Today, there's a lot of people that are self-employed. So they would be considered business for self. You have, for example, contractors, people that are selling certain products, insurance brokers, independent insurance brokers, or, for example, a real estate broker. Okay, everybody declares taxes differently. So, and the banks analyze each file differently based on your type of income. Okay, so certain banks are more lenient with self-declared income. They might require a higher credit score if you want to do an auto declaration for your income, where they don't actually need to see the proof that you did make so much money or whatever. Some people declare less than they actually make because they want to save on taxes. I mean, the banks know this, and so that's why they have some certain programs available for those type of clients. But the new B21 rules are coming out soon, and it might be a good time to renew your mortgage if you're in that situation. You want to renew it before the new rules come out, and which will make it harder for self-employed people to have to qualify for a mortgage. The banks obviously love salaried workers. Usually, for salaried workers that have been more with the company for more than 2 years, they only require a pay slip, a recent pay slip, a letter of employment, and just 1 year's NOA. Certain banks only the federal notice of assessment. The importance of the banks, why they want to see the notice of assessment, is just so that they can see that your taxes are up to date. Because in Quebec, with the civil code, if your taxes are up to date, the creditors, for example, the provincial or federal government, can put a legal hypothec on your home, and that will bring them even to first ranking before the mortgage lender, mortgage holder, which the banks always want to be first ranking. Okay? So if you owe a few $1,000s in order to qualify for the mortgage, you might have to pay that off. I mean, if you only owe the government maybe a few $100s, then some of the banks will allow you to don't have to have that paid off before they lend you the money. Going back to business for self, T1 generals. Some people have revenue by just rental properties. I have clients like that, and so on the T1 general, they would have a rental statement, rental income statement, and it would break down the gross rents and the net rent, all the expenses, and then the net rent. And then we can use that to calculate the income, which we have to use ratios later on. I'll explain that to you in the next slide. And business also. For example, if you were a contractor building homes, or specifically, let's say a plumber, and you gross over 200,000, 250,000, something like that, but you might have a net of only 40,000. I've seen that as well. But because you're a professional tradesperson, the banks will, and if you've been in the business more than 2 years, the banks will allow you some leeway and maybe allow you to have stated income. So that way, instead of 50,000 declared income, we can probably go up to 70 or more. Uh, Rule of thumb for some banks, 15% is what they allow you to gross up on your revenue if you're self-employed. Okay, so because they take into consideration, yes, the car expense or whatever, some expenses are deductible, but they are part of your income, so they allow the 15% gross up. Okay? So it depends on the bank and the situation, what type of work you're in. It's just a general rule of thumb. They also like to see paid school taxes and municipal taxes because, as I was saying before, uh, any kind of government taxes, they take precedent. They would have first ranking over the bank's normal first ranking right to your home. Okay, so you can get a 60-day notice for school unpaid municipal tax. And I have seen in the local newspaper some people's homes being taken and sold at auction because they didn't pay their municipal tax. They have the right. So it's in the Quebec Civil Code, if you didn't know. And for refinancing, the banks would like to see the current mortgage statement with the account number and everything. So that way, when the notary does her work or his work, and they get the balance, they have all the information required to get the final payout. And then the notaries will do the disbursements when you go to notary to sign for your new mortgage. Okay. Moving on. Okay. Income. Yes, there's. If we went back to the triangle before, that income was a very important factor that the banks take a look at. We have what they call two ratios, which the banks use to calculate your income. Gross debt service, which is it's explained at the bottom here, the second line right here. Capital plus interest plus taxes plus heating. These are the costs which go into the gross debt service. And for total debt service, TDS, you have the same similar three: capital plus interest plus taxes plus heating and debts. Okay. So depending on your credit score, that's why in the beginning I mentioned a better credit score. We aim to try and have 680 or more. The higher your credit score, the more the capacity you have of borrowing. You see the numbers here, 39% and 44% of your gross income. So that's how they correlate. So if your credit score is below 680, you have less amount of your gross income that can be used to calculate your gross debt service or your total debt service. All this is mumbo jumbo for you now, but maybe in the next slide you could see what I'm talking about. Moving on to the next slide. Okay, so in this example, you have gross family revenue of 70,000, and the beacon score. I just took an average of 650 just to make it interesting. You have the 650 credit score, you're allowed 35% and 42% for TDS calculation. And this is actually the old school way of calculating GDS and TDS. When you go to the bank, they'll just enter your numbers into the computer and it spits out whatever. But this is the old-fashioned proper way of calculating GDS and TDS. When I do the same thing, when I enter the same information into my what we call the Philogics, that's a special software for mortgage brokers all across Canada. It spits out all the numbers and variables, and if the numbers fit, then we can present the file to the bank. So the old-fashioned way, I'm going to show you. We'll start with the GDS. So 35% of 70,000 will give you 24,500. From that, remember if you went back to the previous slide, is we have to pay taxes, we have to take off the taxes and the heating. And that's it for the gross debt service. So if we do that, we're left with 19,500 per year for the capital and interest, which is the mortgage payment. Divide that by 12 months, and it would give you a maximum mortgage monthly payment of 1625. Okay. Just to let you know, it's the lower of the two that we would need for qualification. Okay. In this case, same thing, plugging in some numbers. 42% of 70,000 will give you 29,400. They would use this figure to take away the taxes, the heating, and they have 3 car payments, which is about $300 per month, so it works out to 3,600 per year. And the couple has $10,000 in credit cards, which is low. I've seen a lot of cases recently where credit card debt is very heavy on the client's minds, and they have to, I mean, the financials, and they have to consolidate their debt. That's why people refinance. And I can help with that. It's not untypical to have 30,000 or more for credit cards or line of credits today. Okay, but even with just $10,000 credit card, the payments for calculation purposes works out to $3,600 per year, because you know credit card interest rate is 14 and higher. In most cases, 19.99% on some of the cards. So if minus all these expense, and it gives you 17,200 left, which is lower than the 19.5 on the GDS side. So in this case, we would use this calculation to figure out our maximum mortgage amount. So dividing this by 12 months would give you 1433 per month. When I use this 1433 per month as your monthly mortgage payment, putting some numbers backwards on my calculator, my professional business calculator, it gives me approximately 300,000 would be your maximum mortgage. I mean, this can change because obviously if you're buying a house that's 400,000 or 350,000, your taxes might be more than 3,200. I mean, the heating is okay. The banks will accept this. This would be sort of the high limit for heating costs. So this is an estimated amount. It's not necessarily the true figure, but plugging in our numbers into the computer will be more accurate. But for example, I do this equation to clients who want to purchase their first home, and a lot of them ask me, what do I qualify for? And this is the way I would show them the calculations. And this is and usually by doing this, and if they're happy and they can go, they're sort of pre-qualified to go shopping. Now, speaking about pre-qualifications, yes, when clients do come for me for pre-qualification or pre-approval, it's two different things. Pre-approval is what we have to submit to the bank, and we get an answer from the bank. What I do here, this is just like a pre-qualification. But all this is subject to verification of the documentation. So because even though I put 70,000 gross family revenue, but for example, if the client just started working 2 months ago at this company, I cannot use that as the real revenue. So there's a lot of rules and regulations about income and how to calculate income or what income to use. Okay, so this is just a general rule of thumb. For pre-approvals, yes, we do have to submit without the documentations. What I would do for pre-qualification is I would take all the client's information as accurately as possible and put it into the computer and build up our file logics and submit it to the bank. And I would usually submit it to the bank that is more friendly for the clients and meeting the client's needs. There's a few banks that doesn't accept pre-qualifications anymore. Laurentian Bank being one of them, and we do business with Laurentian Bank. So they just changed their policies. There's a couple of other banks too that don't accept pre-approvals. They would take your promise to purchase when you're doing a purchase, yes, and they'll do the file right away. But for pre-qualifications or pre-approvals, they won't do. It's for them. It's a waste of time because what happens with pre-approval sometimes you can get pre-approved, but the banks don't see the documentation, so they can't really verify anything, and they're just taking the mortgage brokers' data input as to get you pre-qualified, pre-approved. But what happens also is that if you're buying with only 5% down, the final authority would be the one of the three default insurance agencies, CMHC, Genworth, or Canada Guarantee. They're the ones that authorize the deal. Because the bank might approve the deal, and the insurance company might turn down the deal because there's something they don't like about the file. So even if you do have a pre-approval from a bank, let's say you go to a bank or BMO, you do have a pre-approval, you go shopping, and then when it comes time to making the offer, doing the promise to purchase, and then you're ready for the full application, you might get turned down at either by the bank or by the insurance agency if they don't like your documentation. Okay? So pre-approval is not 100% guarantee that you are qualified to buy a home. Okay? Documentation is very important. And as a mortgage broker, I usually, if the file is a little bit difficult, I would speak to the BDMs, the business development managers of each bank or a few banks which I think the file would fit, and I would ask them, what do you think of this file? And some of them would tell me, yes, we can do it, no, we can't do it, present it this way. You see, that's very important. I have a very good relations with a lot of the major banks, all that I do business with. They're on my speed dial sometimes, or a couple of them are anyways. And whenever I have questions, I just text them or call them right away or send them a quick email explaining the situation, and they get back to me. So, for example, right now I have a file I'm working on, and the clients want to purchase a home. I gave them advice on for the down payment and things like that, because this one particular bank will accept 30 days funds in the client's account only. So some banks want 90 days. So you have to, as a mortgage broker, I know some of these little details, and I would direct him to the bank that would accept his file. It might not be the best interest rate on the market, but it's what the client needs. So, and having the best interest rate on the market is you have to qualify for it. Okay, it's not just given to one. For example, if one bank is offering 2.89%, the other banks are slightly higher, but in order to get that 2.89, you have to fit into the box of all the criteria of that particular bank. It could be, for example, quick closing. A lot of banks give me promos for quick closing, 45 days or 60 days. So you have to be by notary in 60 days. If you're purchasing a home and you only plan on moving in 90 days, that rate is not good for you. You do not qualify for that rate. In other words, okay. So don't get confused, or don't get sort of sucked in sometimes by when banks offer these special rates. They could be for quick close only, or depending on the banks, there's always some terms or conditions. Okay? So as a mortgage broker, I know all the little nuances of each bank, and I would advise you properly. Going to the This is my sort of my last PowerPoint. I have some reasons for you why you should use a mortgage broker. I'm not going to read it. You can read it yourself, but I'll just give you the sort of the highlight. Okay. So more choice. Actually, if you are a good qualified client, you kind of choose any bank you want. But for example, I tell this to my clients. They're earning high income, both of them, and they have little debts. Their credit score is fantastic, right? So they can qualify for almost all the banks. Wow. But if, let's say, three of them are offering the same rate, which bank would you choose? And that's where I can come in. I could come in and tell them what are the pros and cons of doing business with each bank. Because when you go to a bank, they don't tell you. They always tell you the pros. Oh, this is a good product for you because of this benefit, this benefit, this benefit. But don't tell you the cons. As a professional mortgage broker, I know the cons. It's all in the contracts. A lot of you, of course, have never probably seen mortgage contract or deed of hypothec. I have access to that. It's all public information. But I have special access because I have special software and I'm a professional. I can easily access that information. Every bank will have different contracts. Some of them could be as short as 21 pages. Some of them can be 32 pages. So depending on which bank you do business with, the contracts can be short or long, and with a lot of clauses. What a lot of people don't know, when you sign at the bank or the branch, you're signing the mortgage commitment, or in French, the engagement. That's usually only 2 or 3 pages, and they usually only specify the terms, the rate, the amount, and the amortization period, and a few other little things. But that's the meat is in the contracts where you sign at the notary, and that's where the penalties are spelled out, and your prepayment options, and all this stuff, mumbo jumbo. Yeah, so as a professional mortgage broker, I can advise you on those little details. Independent and objective. Okay, yes, since I do not work for a specific lender, I don't work for any particular bank, I give unbiased information and recommendation to the clients. The banks basically pay us the same commission, so it doesn't matter for me which bank I present the file to, as long as it's the right one for the client and the client's financial needs. Going back to the example where the client has the deposit in his account for only 30 days, I can present it only to one particular bank. And so we have to go with the rate of that particular bank. But they do have some options. You can take a variable rate, you can take a 4-year fix or 3-year fix instead of the 5-year, but they have to qualify. So it depends on the qualifications of the client again. Okay? So, discounted rates, yes. As professionally licensed mortgage brokers, we have specials, we have promotions. We're given updates almost every week by different banks and different lenders. They're always competing with each other, so they send us updates. So this week we have, for example, this bank is offering 2.89% for 5 years. They put little conditions, of course, but It's okay if my clients qualify for that and the conditions match their needs. It's fine. They can get that special rate. But sometimes I can recommend to a client maybe taking the variable rate might be a better option because they plan on selling their home maybe in 2 or 3 years. Um, so go for a variable rate at that in that case, and you're only stuck with 3 months interest penalty. I have clients that want to refinance because they're heavily indebted, uh, and they do have the capacity to refinance. But when they ask their bank for the payout and the penalty, sometimes 12,000, 15,000. When they have a 5-year term and there's 2 years left or 3 years left, could be a 15,000 penalty. Oh, there's nothing we would want to do to change that. Even if you get a better rate instead of a 4.5%, maybe it could be a 2.89, for example. It wouldn't be worth it for them to change. But we do have solutions. Maybe they could get a line of credit if they qualify. Line of credit would be at 3.5% only, prime plus 0.5. So whatever the prime is, just plus 0.5. All the major banks are offering that. Anyways, that's where a mortgage broker can come in and find a solution to help you. Okay. Preserving your credit rating. Yes, some people are not aware of this, and they go shopping on their own to try and get the best rate. By all means, you can go and do it yourself, but you might be affecting your credit score without knowing it. Because every time you go to a bank and you ask, for a mortgage, and if you give them authority to pull your credit report out, they're going to bring down your credit score. I mean, in order for a bank to analyze and give you the best rate, they gotta know a little bit about you first. Who knows what kind of job you have? They don't know your work history. They don't know your credit rating. Maybe your credit score is so low, but they don't know that until they pull out your credit report. And if you allow them to do that, in order for you to get the best rate, because they only give that to the better qualified clients, less risky clients. That way, if they do pull out your credit, you're for sure it's going to affect your credit score. So, but by dealing with a mortgage broker, I only pull out the credit bureau once, and it's good for 30 days. So we do have time to analyze your file, and if it's not good enough, I would give you advice and say, okay, and if you're not in a rush, it depends on your financial situation. If it's a refinance, for example, let's fix up your credit bureau first, and then we'll make the application a few months down the road. And so this is how, as a professional mortgage broker, I work with my clients and give them advice on how to, when to make an application. If their credit rating is not good, we have some time, and we can do it. Give case in point, I had a client last year which had a credit score of 590, which is below 600, forget it. You have to go to a B lender, which the interest rates are usually between 5 and 6%. So I gave her some advice, and her mortgage was due, in a matter of months. So what I did with her is I went over her credit report, gave her some advice, and I told her what to do to fix it up. So in this particular case, 2.5 months later, I brought her credit score up from 590 to 687, which is more than what we really need. So following my advice, we were able to get her, very best rate at that time. And the bank, she had the choice of the banks, So this is fantastic news, and the clients, we become friends afterwards. When I'm able to help a client like that, they're so grateful. I mean, this is why I love my job. It's because I'm able to help clients, help people that want help, that want my advice, and I love it, and I have a passion for this, making people happy. Okay, and last and not least, my service is free. Uh, Mortgage brokers in Quebec are not well known. There are only less than 600 professionally licensed mortgage brokers in Quebec. If you go on to the our professional order, which is the OACIQ, Organisme de l'autorégulation des courtiers immobilier de Quebec. We sort of fall under the same organization as the real estate brokers. There's about 13,000 of them. There's only about 600 of us. But we all fall under, we have different licenses, but we all fall under the same order. So what's different between us and the real estate brokers? The real estate brokers, they're paid by the seller. So usually the listing broker will get paid by the homeowner who's selling their home, a percentage or whatever. Okay. Myself, we're paid by the banks, no matter which bank we present the file to. So our service is free to the clients. Okay. And of course, like I mentioned, all the benefits of dealing with the professional mortgage broker like myself. You do get our personal attention. I mean, I had clients that call me at 9 o'clock at night. Try calling your banker at 9 o'clock at night, or something like that. So it's kind of, they don't work. I don't see too many working after the 9 to 5 kind of thing. So, and of course, we will help you find the best mortgage with the best terms and conditions. Very important. So this wraps up the my presentation. Thank you very much for all those participating. I see Malik. Hi, Malik, and or Malak, excuse me, and whoever's out there for the future. This will be recorded for future listeners as well. And I